Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key recent pattern here, unlike the American markets, had been the mid-March to mid-May shallowy bearish shift pitch hook. 2 Fridays ago, the market punched up through the upper time, currently at 193 3/4. The first time since June last year, when it was still a nascent pattern. However, that day and most of the following week, the market hesitated around the next resistance, which is the congestion between 197 1/4 to 198 1/2, containing the July 21 low at 197 1/4, and importantly, the slowly declining gold long moving average, currently at 197. In the process, the market formed a small bull flag. More on that one later. Now, I said 2 weeks ago about this move, and I've now seen it justified, and I quote, "This is a potentially transformative event, and I'll be watching it closely," end of quote. Yet this was not the only pattern seen in this market, as I also pointed out 2 weeks ago when I said, and I quote, "You see, we also have 2 other patterns, both rectangle patterns. The first is the older September to November 25 rectangle between a congestion around the combined March 24 and September 25 lows at 187 3/4, specifically a congestion between 186 3/4 to 187 3/4. That is the bottom of the rectangle. The top is a congestion between 197 1/4 and 198 1/2, containing a July 21 low at 197 1/4. The second rectangle is derived from the first and utilizes the same base, but has a closer topside based around the flatlining mauve medium moving average, so significantly narrower. We reached both the primary and secondary targets for the second narrower pattern 2 weeks ago. The larger rectangle pattern had a primary target X up in the 205 1/4 area, with a secondary hard to reach target X1 up in the 207 1/4 area. Both these targets are within an old congestion band dating between December 2018 to February 2019, between 204 to 208. Yet today, we have reached up and indeed through both targets. Finally, the very recent bull flag pattern I spoke about earlier had a primary target at 200 1/2 and a secondary harder to reach target X3 up in a 205 3/4 area. Last week, prices reached the primary target, and today the market reached the harder secondary target X3. So what now? Well, there are 2 other features to consider here today. First, the idea of a rounded bottom pattern here, something I've floated on the other grain markets, and one I think that is valid here today. For this, I looked at the June 25 high at 221 1/2, just over the May 23 low at 221 1/4. I'll watch with interest if prices rise to those levels, and also the action there. Secondly, it's an old technical analysis technique, but one that I recall worked well in the grains during the start of the Russo-Ukrainian war back earlier this decade. And that is doubling, tripling, or even more of the bull channels, in this case specifically the mid-February start of March bull channel, currently 200 1/4 to 207 1/2, which doubled up becomes 207 1/2 to 214 3/4. And we have just reached the top of that primary bull channel and peaked there and just closed. I wouldn't say over it, I'd say on it. Let's be conservative, I say on it. I would additionally point out that right now just above the doubled up bull channel is the 50% absolute Fibonacci line, which is at 218 3/4, and that is something to pay close attention to. Minneapolis wheat. The market here, as I've said often in recent times, looked and looks more in common with Paris milling wheat than Chicago or Kansas City wheat. The catalyst for the latest move up has been the push up and close over the slowly declining gold long moving average, currently 593 3/4. Last week, the market exploited that move up, and we have pushed up not only clear over the gold long moving average, but also the resistance from the April 21 low at 606 and the October 2018 high at 611. This all ties in with my thoughts from 8 weeks ago when I said, and I quote, "This leads me to what has developed since September, but really since mid-October, and that is a possible sideways rectangle pattern between the uptrend below and just under the gold long moving average overhead. This might become the immediate pattern to watch." Well, that is what has happened, and we broke out higher, up higher, out of the rectangle pattern, and 2 weeks ago I gave targets for such a break. A primary target up in the 611 area, right on that October 2018 high, with a secondary harder to achieve target X1 up in the 616 area. Last Friday, prices reached the primary target at 611, and yesterday the market reached the secondary target. Additionally, over the last 3 weeks, much like other wheat markets, we have formed here a small bull flag. A primary target in the 601 3/4 area, a target was reached last week, and a harder to reach secondary target X2 up at 615 3/4, smack bang on that target X1 at 616. Today we have also reached target X2. This brings me to my final point today. It's an old technical analysis technique, but one which I recall worked well in the grains during the start of the Russo-Ukrainian war back earlier this decade, and that is doubling, tripling, or even more of bull channels. In this case specifically, the mid-January to late February bull channel, currently at 583 to 602 and a half. Sorry, 602 and a quarter, which doubled up becomes 602 and a quarter to 621 and a half, and which capped the market yesterday. Now tripling this higher, currently at 621 and a half to 641, gave another topside resistance above. The next resistance is that where we've peaked today, which is the April 24 low at 634 and 3/4, and close to the 38.2% Fibonacci line of the May to August 2024 move at 644 and a half, making it a quadruple bull channel up. Well, that gives us even more, a channel between 641 to 661. London UK feed wheat. Since the peak in mid-July last year, we've seen prices ease lower, moving eventually below all the moving averages in late December last year and penetrating lower as recently as Christmas week, but not managing to stabilize down there. What is more important here, and this is key, is that we are even now still, well, the market may be still trying to establish longer term, if it's really close at the moment, but below the very important dark blue neckline extension on my daily chart, currently at 168.85, a neckline to a pair of very long-term patterns which I'll shortly detail. Now, I also drew some weeks ago a bright green, late January to mid-July, quite shallow bearish shift pitch hawk, hopefully show the newer bearish angle of attack. In this pattern, the market is between the bright green upper tie and above, currently at 174.40, and the bright green middle time below, currently at 151.80. And to be honest, this pitch hawk has been disappointing. And as I said 9 weeks ago, and I quote, "I really don't think this pattern adds much to the conversation right now." End of quote. This all leads me to my final points, the same final points I've been discussing here for well over a year, and some of them were something that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern. That's akin to a double top pattern, but formed after a big fall, such as the fall we had in early 2023. As well as this, we have an even longer second pattern, an August 20 to April 25 very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart, currently 168.85, the same as on the daily chart I just spoke about. Thus, from these two longer term bearish patterns, we have a primary target X3 for the bearish cat's ears pattern. It'll be down in the 127.5 zone, and a secondary harder to reach target X4 down in the 112.85 zone. For the head and shoulders top, we would have an even lower primary target, X5, down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. The 1975 to date, yes, a half-century old uptrend, currently 66.20. I'm not even going to give you my secondary harder to achieve target for this pattern, as it is below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July, with changeover, through a major spanner in the works for such longer-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5, and just under the bright green 2023 to date upper bear channel line, currently 173.20. The question is posed, and it's a longer term question, is whether this was just a reactionary single month move higher or the beginning of something else. Okay, for the first time since I started showing these longer term patterns, and at least since January this year when I completed my longer term commentary here, I am beginning to think that these two bearish patterns might not be the way forward, and that we might very well be building a base, especially as this week is set up to be a possible weekly key reversal up, which I waited to find out, and it actually is a weekly key reversal up. However, there is still one caveat to this basing higher idea. It's one I've already mentioned. The bright green mid-23 to date big bear channel, currently 126.05 to 173.20. Even with such a big reaction move back up mid last year, we are still sitting within this big bear channel. And it does have the advantage of already having had at least the minimum 5 touches necessary to legitimize it as a bear channel. Now, for all this discussion here, we're still dealing here, say, with some very, very long-term patterns. You should please bear that in mind. But I would note that the bright green upper bear channel line crosses down through the purple neckline about the end of August. I suspect the market will not wait till then to produce a solution. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.